Welcome back. We have covered the journals and underlying theory. Yes, we'll go and apply it in another example, do the actual calculations in a bit. But what is the final outcome? All those journals have to lead to somewhere, right? Well, that is going to be the disclosure. So here, let's now go through the finance leases disclosure for lessees. The accounting policy notes, there's no 100% correct template here. What I need you to do, however, is to tell the users of the financial statements how you have chosen to account for finance leases as a lessee. So we lease certain plants and machinery. If it's from non-related parties, tell me that. Okay, tell me as a user that leases where the company assumes substantially all risks and rewards incidental to ownership of the leased assets are classified as finance leases. Nothing new here. This is the theory you've learned, and you're telling the user about how you did the accounting. The leased assets and corresponding lease liabilities, net of finance charges, are recognized on the statement of financial position as PPE and borrowings respectively. At the inception of the leases, based on the lower of fair value of the leased assets and the present value of the minimum lease payments. Remember, there's going to be a VAT difference there between the asset and the lease liability. Each lease payment is a portion between the finance expense and the reduction of the outstanding lease liability, namely the interest and the principal. The finance expense is recognized in profit or loss, and so on and so forth. Okay, tell me that initial direct costs are what? Capitalized or added to the carrying amount of the leased assets, and then are expensed in profit or loss as part of the depreciation expense. Okay, accounting policy for exams, you usually don't actually get asked those, but in the real world, they're very important. Then, notes to the statement of profit or loss and OCI. Nothing hitting OCI here. It's only going to go into the profit before tax. Now here, you will have finance costs, or you're going to have interest on the lease expense, right? On the lease liability, sorry. Then I need you to remember to split depreciation and disclose depreciation on leased assets separately from depreciation on owned assets. That's all there is. Then, moving on to the statement of financial position, let's have a look at the PPE note. Now, you'll see I've done PPE leased, and that must be done separately. Let me write it out separately from owned. Okay, so you're going to separate out the PPE that is leased from PPE that is owned. Carrying on, in here you will see that as part of additions, we capitalize the initial direct costs to the purchases, put a block around it, the total is the additions. Okay, and depreciation will be based on that total figure. Okay, moving on. Also reference to the fact that the machine that is leased is encumbered. Okay, there's security over it, and you will refer off to the lease note. Here we go, I've referred to note 4 for details of the finance lease liability. Then we do the finance lease liability note. Let me put the highlighter back on. I need you to tell me a bit of information about the leasing arrangement. Tell me the asset details. Tell me that the lease liability is secured by the asset in this example, note 3. The period of the lease, the installments that are payable, the frequency of the installments, are they done monthly, quarterly, biannually, annually, etc. Any residual value on the lease. This here I'm talking about the balloon payment, the final payment at the end of the lease term, not the residual value of the asset, right? Okay, then the effective interest rate. Yes, in the question or in the scenario, you'll get given a nominal interest rate. Okay, but remember the nominal interest rate will have to be compounded, either monthly, maybe daily, maybe yearly, or sorry, biannually, etc. and you will then convert it to an effective interest rate and disclose the effective interest rate. Tell the users about any renewal options on the lease, purchase options, contingent rentals, or any restrictions on the lease. Then, the one that seems to throw students and practitioners alike is this reconciliation of minimum lease payments. Now here the format's easy, right? Remember, we're dealing with a finance lease. So you must tell me, as the user, what are the minimum lease payments within the next 1 year, the next 2 to 5 years, and thereafter. And you will split that up between finance costs and the present value. So this top one, the minimum lease payments, will be the actual installments that are payable. Okay, and then you will discount them. You know, you put it on a timeline and you will discount those back to the present value. So this is the discounted present value with the interest and therefore the PV, which is actually going to be your principal amount. Okay, the actual capital. Take note, what is actually recorded as the financial liability, well, that is the actual capital, right? The interest will be incurred as it is over the periods of the lease. It won't be on the books today. The interest will happen as you move forward in time. Every year you will raise the interest expense to go from the present value back to the minimum lease payments. Okay, so this gets tricky now, right? What we need to do is we need to understand that you will have to use a financial calculator or spreadsheet. And I've given you a little example. Let's say the lease inception date was the first day of the current year. Let me bring back my highlighter. First day of the current year with monthly installments for a total of 96 months, i.e. 8 years. So then, in the current year, you took the lease out on day 1. So you'll use your financial calculator and that will be periods 1 to 12 in the amortization function. Then the next year is what you have to disclose in this note, right? That will be amort 13 to 24 in this example. Okay, periods 13 to 24, we're working with months, right? Then the next 2 to 5 years will be periods 25 to 72. Okay, so month 25 of the lease all the way through to 72 of the lease. And thereafter, you will use 73 to 96. Remember, we had a total of 96 months, i.e. 8 years. And you'll put that in and you will go amort 35 to 72 for periods 2 to 5. And you will have the interest and the principal from your financial calculator being the finance costs and the present value. Okay, the lease payments will just be the payments times the number of months. Okay, so that will come by practicing. We'll do an example just now. Take note, a finance lease liability is a financial liability and therefore IFRS 7 disclosures are required. Let's keep it simple. The one that we need to apply here is splitting between current and non-current components of the liability. We'll go back and we will literally take this principal figure here for the next 1 year. That will be the current component of the liability. Nice and easy. Don't recalculate the figure. Okay, so that's the current portion in the current year. Ticked. You'll also need to do some discussions about the concentration of interest rate risk and liquidity risk. Also with possibility of doing a discussion about sensitivity analysis if there's some variability in the lease liability interest rate. Not usually that there is, but just in case, so you're aware of it. Basic disclosures done and dusted. Calculations come from understanding what you're recording. As a finance lessee, you are recording the asset and recording a liability. The lease payments are the repayments of the liability as well as an interest expense. Initial direct costs, you will capitalize to the leased asset and depreciate. Learn the journals I've given you. Then, from the journals, you must be able to post and cover all of this disclosure that we have just discussed. From there, you will submit that disclosure to the users so that they can do with it what they need to. Thank you.